Hello, Investy Besties. Welcome back to Mommy Trader. If you are new to the channel, welcome. My name is Shalise, and I am just a passionate person who loves to talk about investing, and I would love to be your Investy Bestie. I try to make things very easy, very simple, very light over here, and just to help you to learn more about what your money can do. So I hope that you will subscribe, like, and share this video, and leave me a comment down below because I love chit-chatting with you guys. And if you are a returning Investy Bestie, thank you so much for coming back. You know, I always appreciate you guys being here. So on today's video, it's a part 2 to the video I just did talking about how you can protect your money. But in this video, we're going to dig a little bit deeper in terms of taxes when you are learning to invest or just build your wealth. Again, I'm not a financial advisor. I'm not a fiduciary, but I share real numbers on this channel, and I take you inside in our investment accounts just to show you guys what is possible. And I try to be very open and very transparent with you guys, because I feel like if you can see, if you have a visual of what we are doing, then it'll make it a little easier for you guys to understand and then build your own wealth. So on today's video, we're going to be talking all about the infamous T word, taxes. Yes, we're going to be talking about taxes, and don't worry, I'm going to make this video very simple, very easy, and beginner friendly. I'm not going to dive too deep, but I do want to expose you guys to how taxes impact your investments, because it goes far beyond just your 9-to-5 paycheck. If you really don't have your eye on what your money is doing, you're going to be paying more taxes than you need to. Now, this video is not going to be talking about how you can avoid paying the IRS, and this video is not also going to be political. We're just going to stay on topic, and we're going to talk about money, and we're going to talk about taxes, okay? And keep in mind, I'm not a financial advisor. I'm not a fiduciary. I am someone who is passionate about sharing financial knowledge, and I do feel like we need to educate the masses, because if people knew about this, people would be able to save more money and allow their money to grow more on the back end. So guys, I hope you guys have a piece of paper, a pen, save this video so that you can come back and refer to it. But let's get right into this. So taxes is one of those topics that's not talked about, and if it's talked about, it's so vague and so generalized, or it's hard to understand. But, and like I said, your Investy Bestie, I got y'all, and we're going to break this stuff down. And one reason why you should have some type of insight, at least general insight into investing and taxes, is because you will be subjected to a lot of consequences and penalties if you don't have, this type of understanding. So let me just quickly tell you guys some of the negative things that has happened to my husband and myself because we did not have the proper knowledge or wherewithal when it comes to our money. So I talked about in the video that I will post here our financial fails, where we access, or I did, let me just go on and tell the truth, a 401k. So I took that money out early. Now, I was not even aware, or really thinking about it anyway, that there was going to be a 10% penalty, and I would have to pay taxes at my current taxable income rate when I took that money out early. And here was the thing. I took the money out of that 401k and spent it on clothes and shoes and rent and just different things like that, because I wasn't even being responsible with the money that I had. And I made enough money, but I wasn't responsible with it. So I took money out of the 401k. And then the thing is, by the time I actually got the money in my hands, they took like a third of it. I wasn't even getting what I initially thought I was getting, because I wasn't thinking about, girl, you're going to have to pay taxes on this. You also going to have to pay a penalty too. But again, guys, if I was more aware and I was more responsible with my money, I could have avoided that disastrous mistake. The second thing was, in 2019, we had to pay $14,000, which is still bad, in taxes to the IRS. So we had to owe them $14,000. So what had happened was, my husband was given some stock in a company he was working at. The company sold. Well, my husband, of course, if you hold a position for less than a year, you are subjected to short-term capital gains tax, and you will be taxed at whatever your current income tax rate is. We weren't thinking about that, and we had just no clue. We figured, oh, well, whatever tax they took out was enough, but it was not enough. And so we didn't set that money aside. So when we filed our taxes and we hit the whole submit button, and Free Tax USA said, you guys are going to have to pay $14,000 to the IRS. We were like in shock, and we were scared, and it made us realize, okay, anything that we get that we have held less than a year, we need to make sure we have that money set aside, even if they took taxes out, just to be on the safe side. And that is a tip I have for you guys. If you have a business, if you are getting money from YouTube, things like that, and you're not sure how much to take out when it comes to your taxes, take out a little bit more. Just add 5% to whatever that number is. So if you're taking out 20% and you're not really sure, bump it up to 25%, because with the IRS, it is always better to have a little bit extra set aside versus not having enough set aside. I want you guys to avoid making those same mistakes. Now, I will tell you guys, we don't mind paying our fair share in taxes. So far this year, in 2021, we have paid over $36,000 in federal tax alone. That's not counting state. That's not counting FICA or the thousands of little local taxes that they have going on. That is just federal tax alone. We don't mind paying our fair share because we know we are high income earners. But anything over the fair share, we want to keep in our pockets. So if I sell products on MT1 Finance, or if I am doing services, or my husband does his consulting side businesses, we want to be able to keep as much of that money in our pocket as possible. And so this is why we have to really have some type of education into the tax structure of our money. So let me talk to you guys about the three main tax buckets when it comes to your investments, because it's really important to understand how you structure your investments when it comes to taxes, especially if you are trying to retire early, because again, there are different tax caveats. You can't access your 401k before the traditional retirement age. So if you're trying to retire at 40, you need to have something to live off of. And so you'll have some of the method behind the madness when I start talking about these three tax buckets. So the three main tax buckets are your tax deferred accounts, your taxable accounts, and your tax-free accounts. So let's talk about the tax deferred, and I have my notes here because y'all already know. So tax deferred or tax advantage, you may hear both terms used interchangeably, but they both mean the same thing. It basically means you don't pay tax now, you pay tax later in the future. A lot of people like these types of accounts because usually in the future, your taxable income rate or bracket will be lower anyway. Usually people, when they retire, don't have higher incomes, and as a result, they're not in higher tax brackets. So we're talking about like your 401k, which is through regular companies, your 403b, which is more like nonprofit educational type of fields, and then you have your 457s, which are like government sponsored type of retirement accounts. And the great thing about those types of accounts is that that money is taken out pre-tax. So you are already saving for your future before the government takes out all of the thousands of taxes that they take out. You're already setting money aside for your future. And if you get a match, that essentially is free money. Now, there may be vesting schedules and things like that, but at the end of the day, a match is free money. And if you get a good match, okay, a good match is like what, 10%? Let me know down below what type of match you get if you feel comfortable sharing. But if you get like a 10% match, definitely try to take advantage of that if you can. My husband gets 5% match. I think that's the highest that we've ever gotten, which was, 5%. Now, the con to that is that you can't access that money until 59 and a half. So like I mentioned earlier, if you try to access that money and you don't fit the requirements, you will have to pay a penalty and a tax. And then after they take out everything, it's just not even worth it trying to access the money. Now, I know there are different loopholes, like if you're going to buy your first home and things like that, but just for the sake of this video, a con is you can't access the money. So it's not really liquid, okay? But it does grow over time. And the great thing about it is that usually people have a lower income tax rate anyway when they are retired. Most seniors don't have a lot of earned income, and that money will be taxed at that tax bracket. So that's why people love tax deferred, and I really am a big fan of tax deferred as well. Moving on to the taxable account. So this is an account that a lot of you guys are familiar with. These are your M1 Finance, your Robinhood accounts, your Webull accounts, your Interactive Brokers accounts. These are accounts where any gains you make are taxed. So yes, you have to put money in these accounts with your after-tax dollars. That means any money sitting in your checking account, that money has already been taxed. So this is what you're funding those types of accounts with. The downside is that the gains are subjected to tax. So this is where capital gains tax kind of comes in. So you have short-term capital gains and you have long-term capital gains. So short-term capital gains applies to anything that you hold for less than a year. So that means if you hold a security, that's a bond, that's a stock, that's a fund, that's a crypto, for less than a year, you will be subjected to short-term capital gains tax. The negative thing about short-term capital gains tax is that you will be taxed at your current income tax bracket. So if you don't know what your current income tax rate is, go back to your tax return from last year, find that number, and then compare it to the chart that's from the IRS, and I'll have the chart somewhere here on the screen. That is how much you will have to pay in short-term capital gains tax. So just going back to the $14,000 we had to owe in 2019, we were subjected to short-term capital gains and our taxable rate was 28%. Our income tax rate was 28%. So 28%. That's why we had to owe an extra $14,000. But we didn't know that because we didn't have any type of understanding. But now that we do, I'm here to share this information with you guys. So yes, short-term capital gains, if you own a security for less than a year. So a lot of you guys were doing Dogecoin. You know, if you made a profit, set that money aside so that you can pay the IRS, because Fidelity, Webull, Vanguard, Interactive Brokers, Robinhood, M1, they will all send taxable statements to the IRS and to you come tax time, okay? So you want to make sure you have a little bit extra set aside. That way, if you need it, you'll have it, okay? And we are doing the $1 investing challenge. And again, a lot of you guys are using taxable accounts to fund your portfolios. And remember, guys, any gains you make will be subjected to capital gains. But if you are a long term, if you are buy and hold, we are not selling anything, okay? That means we have Apple, we have VTI, we have the Vanguard Consumer Staples, and we have Walmart. We're going to have 4 securities at the end of November, and we're not selling anything. We're building our portfolio. So every month we're adding securities to this, and we are buy and hold investors. So that way, when you do access this money, you will be subjected to long-term capital gains tax. And long-term capital gains tax is usually 15% or less. Some people pay nothing. Okay, it gets really real. Sometimes you can pay nothing by having other different type of asset classes. So if you have rental properties, you can write off in deductions and all that. So when you add all that stuff up in the background, your investment accounts, your rental properties, and all these other types of avenues that you have going on, your businesses, you actually may get a refund from the IRS. We got a refund last year from the IRS, and you guys know we make a decent amount of money. So again, this is why we stay diversified. That's why I'm always talking about have your money working for you in different places. So yes, and the great thing I love about taxable accounts is that the money is easily accessible. So like with the 401k, you'll get a penalty if you access that money soon. Well, with your taxable accounts like your M1 Finance, your Robinhood, it's very liquid. You can access that money and have access to it within a day or two. I mean, that's one reason why I love those types of accounts. I can have access to it. Let's talk about your tax-free accounts. These are the ones that I love the most, and I think most people love the most. These are funded, again, with after-tax dollars. So money sitting in your checking account, that's what you will fund these types of tax-free accounts. But these are like your Roth IRAs and your Roth 401ks. And I know a lot of you like the Roth IRA, and I do love the Roth IRA. And some news here, we just funded our backdoor Roth. So I am filming a separate video for that so I can document that process for those who are interested. But yes, we did fund the backdoor Roth as well for 2021. So money grows tax-free. So you put after-tax dollars in it, and literally you could be a Roth IRA millionaire. Okay, that is how deep this goes. All of that money is considered tax-free. So I just wanted to let you guys know that even with the Roth 401k or Roth IRA, there are limits to it. So with the Roth IRA, there is a $6,000 max contribution limit. Now, if you are over the age of 50, you can put $7,000 into your Roth IRA. And keep in mind, there are income limits as well. And if you exceed those income limits, then the backdoor Roth is an option for you. But like I said, if you're interested in that backdoor Roth, stay tuned because that video is coming out soon. I am just in the process of filming and editing. But yes, those are the 3 main tax buckets. And let me tell you guys, I didn't know this until I did more research. So I thought initially the HSA would be considered a tax deferred because the money goes in pre-tax. But actually an HSA is considered tax-free. And now when I did more research, I understand why now they consider it a tax-free account, because the money goes in tax-free, the money grows tax-free, And then when you withdraw that money and use it on qualified medical expenses, it is also tax-free. And then the loophole here is that if you pay as many of your medical expenses out of pocket, so that root canal that I had last week, I paid for that with my Amex card, got some points and some cash back, and I uploaded that receipt to Fetch Rewards. Yes, you can upload that type of receipt to Fetch Rewards. I didn't even know that. I thought it was just groceries, but you can do that. And then I just have that receipt uploaded to the cloud, and then years in the future, when I'm ready, we will reimburse ourselves from our HSA. And that way we can let that money in there continue to grow over time. I think the HSA, besides the Roth IRA, is probably our favorite type of account when it comes to taxes, because you literally don't have to pay any tax with the HSA if you structure it correctly. So that's what we plan on doing, especially when we achieve our early retirement number. And remember, dividends are also subjected to taxes as well. So keep that in mind. Make sure your dividends are set to reinvest. So you got to go to your settings. There's a little button. It may say yes, or you may have to slide it over, but make sure you have your dividends set to reinvest so that you're not triggering a cash tax event. You're just getting those dividends kind of reinvested back into the position over and over again. And that's where compound interest will work for you. So that's the video, guys, talking about just a quick intro into taxes when it comes to your investments. Leave me a comment down below. Which one of these types of tax buckets are your personal favorite? Is it taxable deferred? Is it taxable accounts? Is it tax-free accounts? Let me know which one of these are your favorite, because I really like a mix of all of them. We have accounts in all of these different types of tax buckets so that we can have all of our money working simultaneously. And remember, just start slow. Don't jump in head first. Starting slow. We started with $100 in our 401k and slowly built from there while educating ourselves, continuing to learn, read, and absorb as much information as possible so that we can become the best investors that we can be. Because remember, when you are investing, for every buyer there is a seller, and for every seller there is a buyer, and you can lose money if you approach it in the wrong way. So we want to make sure that we're not day trading, because that is short-term capital gains. We're not shorting or options or anything like that. So if you're a beginner, buy and hold over the long term. It'll really work out for you that way. So again, guys, thank you so much for watching. If you have any questions, leave them down below. Don't forget to like, share, and subscribe. Follow me over on Instagram. Information is down below in the description box. And until next time, I'll see y'all in the next one. Bye, guys.